Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted on Voices of Wall Street to be able to speak to Rob Sechan of NewEdge Wealth, one of America's finest investment firms, looking and serving high net worth, ultra high net worth individuals and institutions. So welcome, Rob.
Thank you. Good to be here, Paul.
Yeah, well, given the recent investor angst over sort of rising bond yields and inflation expectations, what's your sort of top level view of equities and fixed income going forward?
Yeah, and I would have to add into that weaker economic news, right? But when you unpack the economic news, the payroll data from 10/8, it did have some bright spots. The unemployment rate dropped to 4.8%, which was great. And then when you look at GDP, it was way short of expectations, but the revised number still came in at 6.7%, and there was certainly a higher level of consumer spending. That's 70% of our economic activity in the U.S. It grew at a 12% annual rate, which is the fastest surge since the third quarter of last year as the economy began to reopen. So fastest year, I think the anxiety came from the fact that core inflation rose over 3%, in the mid threes, 3.4, I believe. And that's the fastest year-on-year pace since 1991 and way above the Fed's target. So when you have weaker growth and rising inflation, I think everybody worries about a potential stagflationary environment. And, at NewEdge and throughout my 25 years in advising clients, my partners and I have always distinguished the difference between being a trader and being a long-term investor. And from a strategic approach, the best way to do that is have a solid understanding of what you own, to remove the emotional aspects of investing, and to try to hold through and capitalize on market gyrations. We do believe in the value of tactical allocation, and our portfolios are positioned accordingly over a 6 to 12 month time horizon. I would say that right now, equities are fully valued and investor sentiment is above its historical averages when you look at the surveys. So in an environment like this, you're more susceptible to corrections. And so we right now are taking this opportunity to rebalance portfolios. Does not mean that we're negative. It just means we've been wildly successful in some of what we've been doing. But we're seeing pockets of relative value notably in cyclical stocks, and the fact that international developed equities have lagged the current recovery. So, in cyclicals, we like financials and energy. Still like mega cap tech. I know a lot of people are worried about rates and the implications for tech, which we think would be incredibly short-lived. We think some of these great quality growth businesses are building a enormous book equity, and it allows for, while price increases can get ahead of themselves, it allows them to kind of do well long term. In addition, when you're worried about stagflation, these companies have extraordinary pricing power. And they're able to better weather, the kind of inflationary supply chain bottleneck.
So if going forward, we're still seeing a relatively sort of strong economy with higher inflation, and you guys are sort of like, rebalancing and repositioning, etc.
Yeah, I think.
How's your sort of investment model, your process to match? Because obviously your portfolios, and we'll get into some of the companies later on. But I was looking through them all, and they've done really well over the last two years. What's sort of like the magic formula that people could sort of take a few pointers from?
I would say there's a shortage of quality assets, right? in the marketplace, and investors are scrambling to buy quality assets. I mean, listen, there's tons of confusion, Paul, in the markets. Just look at the yield curve. We've gone in the last 2 weeks, we've flattened, we've steepened, you know.
Yeah.
It's clear that the future of the stock market's highly rates dependent, but you tell me what's going to, what's going to be the causes of rate disruption. I mean, is it energy prices? Is it supply disruptions? Is it something as simple as a cold winter? You know, it's really, really tough, given that there's been this rate suppression for so long. And so I think what we've been, the secret sauce for us has been that we've been relative value allocators. And what that's led us to is equities. You know, I would tell you we've stayed away from the really extraordinarily high PE stuff because it's not what we do. Right?
So you haven't been investing in Snowflake then, and people like that, sort of 100
No,
times sales.
no, I mean, you're not going to see us in Peloton, DocuSign, Square, Snowflake. It's really outside of what we do, right? And so I think one of the successes that we have is when we have events, and let's just go back to COVID times, we did reposition our portfolios for quality beneficiaries. Think like Amazon, think like Home Depot.
Yeah.
Right. And really big blue chips that were beneficiaries. And, you know, we did the analysis to make sure that this was thoughtful.
Lockdown beneficiaries.
Yeah, lockdown beneficiaries. And then as we started to see the reopening, we started to reposition to quality reopenings, and we're in quality cyclicals. And I believe you want me to talk about.
Yeah, I do. Yeah, later on
today.
We'll talk about a few of those. Yeah, definitely. Let's move on to sort of like some of the sort of positions I know you hold, and you've had extraordinary success. I mean, over two of them, the top big ones, and people probably know Microsoft and Alphabet. But I was look at the charts over the last 2 years; they've more than doubled in sort of value. So you've obviously, you know, sort of knocked the ball out of the park just on those two. It's sort of like, what's the strategy with those two? Was it just run your winners who are just so big and dominant in their sectors?
You know, it's interesting. There is some run your winners in that. I would like to talk about why we still own them, because you know, in an environment where we think inflation's here, right? And these names tend to be more service driven than hard parts, less geared to inflation mishaps and supply disruptions. There's going to be volatility around regulations, volatility around privacy concerns, but I think they're the most robust holdings in the tech sector. You might want to add a Facebook to that, just in terms of its price and growth characteristics. But let's start with Microsoft. The PE it is the bluest of blue chip companies. PE is not that excessive relative to the sector. There's huge adoption of Microsoft offerings, particularly the Azure cloud services. They're going to continue to benefit from cloud-related revenue streams that have been beneficiaries of the pandemic, and the business is going to continue to grow at double-digit levels. And, you know, in their most recent results, they showed revenue and margin figures just smashing results across all business lines. You know, how can't you continue to own that? Plus, in the United States, with tax rates, it's tough for us to get off that pedal, given that we like the business despite volatility, possibly from rates.
Yeah.
On Google, or Alphabet rather, you know, it trades also at a premium to the service. And again, this is thematic with us paying up for quality. But you have high teens growth rates over the next 3 to 5 years. In addition, right now, it's hard to find. This was one of our biggest pivots. We actually last year reduced our position in Amazon from an overweight to an underweight, put some of those proceeds in Alphabet, because it is a cyclical beneficiary. When you think about travel search and everything,
Yeah.
Alphabet's, and that looks like it worked out really well for us given the relative performance of Alphabet versus Amazon. I mean, they have dominant, strong positions across all their key secular segments: search, cloud, advertising, video, and obviously a track record of execution, and to me an attractive valuation relative to the sector. So we're not going to buy a DocuSign, despite the fact that we use it, we love it, at 300 plus times earnings. It's just not us.
Yeah, I mean, I would agree. I mean, the sort of networking sort of strength, particularly sort of like of Microsoft. Everybody in the world uses Office and sort of like Windows, and also they're moving on to the cloud.
You're on Zoom, Paul. But
yeah,
I usually use Teams, and we have the entire at NewEdge. We have the entire Microsoft ecosystem that we
And likewise with Google in search and advertising. I mean, I used to work for Unilever, and we used to waste so much money spending on promotion on TV, radio, and billboards. And it's just so much more precise, isn't it, online? So these are sort of like huge giants that do. I mean, the only sort of like sort of slight question: if you do get higher rates, etc., would that lead to multiple compression of these guys in the whole sort of tech sector?
Yeah, I don't doubt that these have been super additive to our outperformance. My sense is, again, back to that position, and you heard David Tepper, I think, on CNBC talk about it the other day. If rates stay here, right, and Rick Reeder even said, who runs BlackRock, Global Allocation. Rick Reeder even said, now that we've had this move in rates, they're well supported, right? We are of the opinion that rates are going to continue to head higher, but it's what I would describe as a non-disruptive pace. So, listen, could you get volatility? Yes. Do we want to get out of the way of these long-term secular bets that we have? The answer is absolutely not. So
yeah, so I mean, just stay with it as much as anything. Now, moving to another.
Even if I think the way we're going to pick this up is we're going to add some things at the margin that drive out performance in different places, so you still have a foot on this ski. We ski on two skis here at NewEdge.
Well, another third ski is Taiwan Semi-conductor, because with the chip shortages, they've just been another absolute home run, real winner over those sort of last 2 years.
Yeah, our real winners have been AMAT and Lam Research. This is a relatively newer position for us. TSM has lagged here of late, year to date, and we just think this is a way to play the global chip shortage, this supply-demand dislocation that's going to help the sector's pricing. We're rolling into this laggard. It's more of a play on their new chip technology, which has helped them grab market share from gorillas like Intel.
Who had an absolute mare, didn't they, on Friday?
Yeah. So they're more microscopic and have a broader use case. If you were to bring up the charts on our other two positions that we had, they just hit it out of the park.
The only sort of thing I would say on anything in Taiwanese is that, given all the saber rattling by China and in the South China Seas, is there geopolitical risk here in terms of, because
no doubt that there is. I think it's a matter of pace. Kyle Bass talked a lot about this. TSM's trying to build a facility, and again, this is not one of my portfolio. It's one of our underlying PMs. I believe it's in Arizona, but these things are long lead times to get these things up and running. So I think the belief from my lens is that that's tomorrow's business, not today's. And we do have some saber rattling, but unlikely to lead to a meaningful change. Despite what she said on I think the 8th in his speech. So
another one which has obviously sort of come back really well is JP Morgan, and they came out with absolutely fantastic Q3 results. Was it last week or 2 weeks ago? Do you want to take
We
us
were
through?
really happy about this. You know, we also own Evercore and Jeffries have been monsters for us.
Yeah.
JP Morgan, though, this is one of the best diversified revenue streams in the banking sector. You see an ongoing earnings expansion, given our view on rates kind of grinding higher. We think there's going to be enhanced profitability and just the whole capital markets activity from the reopening of the economy. And gains are going to be further helped by an increase in JP Morgan's fees. And, you know, we're overweight financials. We think that, you know, there's a lot of fundamental underpinnings in the sector, and JP Morgan is by far our favorite. It's one of the highest quality large cap banks that, you know, will benefit from a diverse mix of businesses, enhanced by its strong balance sheet and stockpiling excess capital. These guys are the belle of the ball.
Yeah, and if the yield curve does continue to steepen, or the yield on the 10-year, then you may lose in other places. But actually, JP Morgan's going to work really well in all your financials. So you have a natural hedge there, don't you?
Yes. Yes.
What about, I mean, you've obviously got sort of like your global champions there, which have just been super home runs and real winners. And then you've got some sort of, you know, North American domestic strengths like Home Depot. And as you say, you bought into those at just about the right time when everybody was locked in. What's the sort of outlook for those guys? Because if rates were to increase, and Steve Mnuchin of the former Treasury Secretary, he put out a headline that he thought 10-year yields could get to 3.5%, and Jeffrey Gundlach last week reckoned that the QE was suppressing yields by 2%, and if that's the case, then it's heading out at 3% in the fullness of time.
So, yeah, he said negative 200 is the
which was quite an aggressive call, actually.
It really was. So the whole point that he was making, I think, is that the change in the rate of change is going to be an incredible headwind.
And if that happens, then what's going to happen to the housing market and Home Depot?
So listen, when I think about the housing market, I think about our millennials here in this country. 88 million population, reaching their peak earning and spending years of their lives. Arguably, the jobs market for these folks has never been better. Home Depot's a long time hold for us. We really doubled down at the depths of COVID, simply because it was one of the names that we felt most safe in. It's also up, you know, almost 40% year to date, beating the discretionary sector by a ton, which discretionary is under the S&P, right? I would say that homeowners are in great financial shape, driven by rising home prices and lower mortgage costs, right? Yeah. Even if they go up a little bit, they're still fundamentally well supported. I just look at what I've done at my house through COVID, old Peter Lynch way of investing, right? I was seeing what I was spending on. I was going to Home Depot. It was pretty busy there.
Yeah, and also I guess the underlying demand for houses is still really strong, because I was just actually looking at a chart and I saw the average number of months of supply of existing homes for sale, and it's almost like at a 25-year low of roughly like 2 months, and traditionally it's sort of between 6 and 8 months, and it just shows you how much, you know, the lack of supply. So presumably when that does sort of like that congestion does alleviate and you do still get greater supply, then if somebody buys a new home, they're going to renovate it again, aren't they?
Yeah, listen, I'm even thinking about buying a couple personal real estate investments because the cost of financing's so low and rents have gone up extraordinary.
Yeah,
and I think it's something that's going to persist. I mean, you have rising home prices, lower mortgage costs, rising home equity. You know, makes homeowners incentive to invest in their home improvement projects, right? So there's been increased demand, limited inventory. Home Depot, this is not the most expensive it's been. It's traded at 25 times. It's trading at 25 times next year's earnings. That's a 12% premium to competitors, but below their average premium of 18%. I just think, again, quality, right?
And is that how you distinguish?
Sorry, Paul, didn't mean to cut you off.
Right, no.
The other thing about Home Depot is supply chain, right? And they have a huge competitive advantage if inflation continues to persist, which we suspect it will.
Yeah. And then is that how you sort of like select? You know, you choose between sort of a value play or a value trap. If you stay at the highest quality with big economic moats and USPs, etc., and pricing power, staying up the value curve means it doesn't. Sorry, staying up this, well, effectively the added value curve. It means that it doesn't ever become a value trap. It always stays. Is that how do you sort of make that distinction between a value trap and a value play?
I think especially right now, right? So we're incredibly nervous about stagflation, right? I nervous, but that's not the bet. I happen to think that this economic trajectory, once a lot of these issues are behind us, is a moonshot. I'm not discounting these risks, which is why we're rebalancing right now. Right. But I do think this is roaring 20s type environment. It comes with some danger. You add enough fire, sometimes it gets too hot. But I do think if you own quality, and the way we determine quality is this notion of quality growers at a reasonable price. It doesn't have to be a value price to, avoid being in a value trap. I also just, thinking about energy, which is one of the.
I was just going to come on to that because it looks as though you've perfectly selected EOG, which is obviously a beneficiary of the shale and oil, sort of like. But you've selected high quality again rather than say Chesapeake or something like that.
Yeah. So it's interesting. There's been underinvestment in energy infrastructure in this country, and a lot of investors, and we're thematic in our thinking as well. A lot of investors believe that technology is disinflationary, right? They're right, but there's a transition phase which leads to underinvestment in certain assets, right? And that is why we got very heavily into energy this year.
You and a lot of smart people and hedge funds, because they've run really well, as also Goldman Sachs and people like that all got in early.
Right. And tech is in fact, it's this perverse thing. Yes, EV and different ways of doing things are going to put pressure on the price of energy, but underinvestment in the short run has meant a shortage when you marry it with this opening of the economy. And, so EOG is just an interest. You mentioned they're a shale producer, attractive valuation, 9 times next year, 10% free cash flow, 20% dividend growth, disciplined CapEx, low debt levels, great return on investment capital, and their low cost of production coupled with margin expansion. We think this continues to accrue to high free cash flow growth.
Yeah, no, I mean, it does seem as though the whole energy complex has learned its lesson about capital allocation, being disciplined. I mean, you've got the OPEC saying they're not going to increase production as fast as the market was hoping. You've got Russia joining in and saying we're not going to supply Europe unless you're absolutely desperate, and we're going to charge you over the nose for it. And you've got China, who frankly are shifting most of their coal producers production, the power production, into natural gas and buying up huge amounts.
Hugely competitive for the Eurozone too, which is really interesting. It's almost like a free-for-all to bid up natural gas prices. And, that's one of the big inflationary stories out there, Paul, because natural gas is a key ingredient in ammonia, which is a key ingredient in nitrogen fertilizer.
Yeah.
Right. And increases food costs. And not just energy. I know food's non-core, but still people feel food perhaps more than anything. And the two ingredients that drive inflation, well, are inflation expectations and wage increases. And when you see what's happening, when you see the hoarding of energy by both the Eurozone and China, you can see that inflation expectations are definitely up.
Yeah.
And so, and in the most recent economic statistics, so are wages.
Another one, which is sort of like the reopening, which seems to be coming back, of sort of city centres here in London. I know New York's pretty busy, as I understand. So you've got that, and holidays are going to be massive next year. And business travel also seems to be coming back to trade. Is Hilton Worldwide, which I know you own. Do you want to take us through the investment thesis on that one?
Yeah, 100%. I mean, listen, I was in New York City on Saturday night, and I haven't been there in a little bit. Our offices are just outside the city, and it was bustling. There wasn't a seat to be had.
Yeah.
And the only thing that I noticed is that everyone was younger than me.
I'll tell you one thing next year, which will be massive, and again, which I don't think has sort of been priced into these reopening stocks, is once China and Asia in more broadly, and like Japan, get fully vaccinated up to sort of 80% of America and Europe and the UK, then there's going to be that whole overseas tourism, particularly the big sort of like international centres, is going to come back. Absolutely. It's going to be like the Europe descending on Disney World and Asia descending on New York and London and Paris, which has got to be good for somebody like Hilton.
As Christina Aguilera said, "Come on over, baby. Let's start going back and forth." Right. Hilton, you asked about Hilton. You hit the nail on the head. Beneficiary of increasing vaccination rates and easing travel restrictions. You got to keep an eye on the COVID variants, especially what's happening in the UK, right?
Yeah.
But this, we're going to get through this, right? This is a delay issue. It's not anything but that. So Hilton has $2.7 billion in liquidity, has been able to charge higher fees while reducing costs. It's been a huge winner for us, up 32% year to date, but whole lot of room to run. People don't like it because it's a Wall Street favorite. Well, it's a Wall Street favorite because it's got this great asset light model, network effects, and a loyalty program, a strong brand, and a geographic diversified revenue mix. And I think Wall Street's right.
Yeah. Another one we've done really well on is of a sort of like a COVID beneficiary is Dexcom, which I think is a telemedicine sort of beneficiary in terms of remote monitoring for diabetes patients. Do you want to take us through that? Because it's sort of like done. I mean, the shares have just done exceptionally well over the last 2 years.
And I swear to you, I didn't pick just winners here. we are having a remarkable year,
your portfolio must be as fast as you're driving, given your sort of like your helmet and your racetrack out behind you.
Yeah, I like that too. Only thing is, I've kind of hung up the cleats there. I got done crashing and spending money.
Okay, yeah. But yeah, Dexcom, the sort of telemedicine, is sort of what is the sort of key USPs versus the sort of the big boys? Because I did see it's got a sort of tie-up with Teladoc as well, which is the granddaddy of the industry.
Yeah, so this is interesting. This is one that we do with our friends at Fundstrat. You may know Tom Lee.
Yeah, very bullish at the moment.
Yeah. He sits on my investment advisory board, and he's one of the smartest guys on the planet. We have a great group of folks on our advisory board, which include him, Lee Cooperman, some of the other folks at Fundstrat, Brian Rauscher, Bob Matza, who was the president of Golden Tree and Neuberger Berman. So we have like a who's who, and the great news is we get a lot of divergent of opinion from the friends of our company and our investment partners. So what I would say we saw here is a secular play on the need for healthcare equipment, and glucose monitoring is geared towards the current demographic in the United States. They're a leading manufacturer of real-time continuous glucose monitors in the United States, but also everywhere. And the technology works. And when you look at people with diabetes during the COVID-19, it was one of the leading comorbidities, right? And that resulted in accelerated approval and use of Dexcom's products, and the results were unbelievably successful. So the valuation is lofty, a little different than what we typically own, but the company's results have matched that lofty valuation over time.
Yeah, well, I guess also, there's always a chance it gets bought out, given its sort of strength of USPs and technology, because it's a first mover, isn't it, in that whole space, and presumably the sort of like, it isn't just the technology can also be lifted and shifted if needed into other therapeutic areas, I imagine.
Yeah.
Yeah. And then, well, then really just coming to the final two. No, sorry, actually, there's three. There's sort of like there's two at sort of different ends of the barbell. You've got sort of like Safehold, which is a REIT that is presumably is an inflation hedge, and then you've likewise got Green Thumb, which is a more of a riskier side of the barbell, I imagine. Do you want to take us through those two?
Yeah, so these are owned by one of our great PMs, Glenn Mintz. He tends to ski off piste in terms of what he owns, and he's been an absolute superstar for NewEdge. Yeah. But I would say Safehold's reinvesting the real estate finance business. It fits in both growth, value, and income investors' portfolios. It's a disruptor in the business. Institutional or retail have not been able to participate in this asset class before. This is not a traditional REIT, and it's an asset class that perfectly captures the power of compounding. It's created enormous riches for many of the world's wealthiest families, churches, and universities, and has not been made widely available. So what does Safehold do? Safehold leases the land to the current building owner for 99 years, and the owner pays rent to Safe. The building owner manages and runs all parts of the building's operations, pays all expenses, and keeps all the profits from the building operations. And when the lease ends, the business is the property of Safe, tax-free. So it's got this built-in inflation hedge. If you just, this is not a safe asset, but if you looked at 425 Park, the land lease was $15 million of a $50 million build. That lease has 30 years left on it. It was again a very long lease when the building was built, and at the end, the lessor has a building that's worth $1.25 billion in today's market environment. So if you think about, you have these cash flows, right? But then you have this bullet at the end that's the underlying building value, and what a great inflation hedge. The other thing that it does for the building owner is it raises their return on equity in the building quite tremendously, because of the less capital they have to output for the land. So the risk going forward is that irrational competitors come in and enter and price deals below to the company, because these competitors are doing things that aren't smart. So it's a very interesting business, and I like where they're positioned geographically. They're positioned in the NFL cities, the National Football League cities, and so those tend to, if they're the places you want to own a team, those are the places you may want to own a building too. So
well, I guess it really is ultra long investing, isn't it? Where you've got some like the freehold, and you're giving you're giving people sort of like you're giving it to the leaseholders. Then you take possession at the end of the actual lease, and then green.
Yeah, and, oh, by the way, during COVID, no rent defaults, zero. Okay, because you default, you lose your building.
Yeah,
so think about it's
recession proof.
It's a little calamity proof, right?
Yeah.
So
what about green thumb, which is in sort of cannabis? I understand it's sort of like the boom in America, isn't it? That as sort of like state by state, I think it was legalized in Canada first and is now going through the states. In fact, a bit like online gambling.
Right. So this is a Glen stock. So this is where we ski off piste, and we like it. It's fun sometimes. Lee Cooperman also owns this position. It's kind of interesting.
Yeah.
All the big wirehouses still ban trading. So wirehouses being the Morgan Stanleys, UBSs, those type of firms, Merrill Lynch's, trading in cannabis companies. And so this could be at the forefront of benefiting from a legislation change and regulatory easing from U.S. broker-dealers. And the ripple effects by the wirehouses not being allowed is that you have mutual funds and ETFs that are on their platform. They really can't hold it either. And so institutional ownership is below 10%. And, Glenn really believes this can reach higher levels. The question is not when, it's not if, it's when, right? And over the last few years in the cannabis space, everyone has been chasing the pot of gold at the end of the rainbow. And from the standpoint, there's a lot of unsound businesses out there. And Green Thumb is the Tiffany or Richemont of this industry. And given that we want to be the ultimate wealth management firm focused on quality, this is where we see an attractive opportunity. Their earnings keep going up, but their multiple has been compressed because not many people can buy it. So I think that changes. Glenn thinks that changes. And, the only risk, I think, is it becomes over-regulated and taxed as a health concern. So,
yeah. Well, Europe is opening up now as well on cannabis. So this could be international expansion. And then the final one is Rockwell Automation, which is a sort of like a play on digitization of sort of like industrial production and sort of Internet of Things and stuff like that, I guess, and smart factories.
Yeah, I'm going to say that, this we own in both our quality growth and dividend income portfolios. So it clearly scores well from a fundamental screening perspective. Strong earnings quality, stable historical earnings trajectory, 13% dividend growth, recent acquisitions that should allow recurring revenue to reach 10% of sales by the end of 23. It's the early days of cyclical and secular automation.
Yeah.
And that upturn, warrants kind of a high multiple for this company.
Yeah, so I must admit, when you look at it sort of like build tech, for instance, and you look at sort of like software, which is digitizing the sort of like the whole building industry, then that runway is sort of 10, 15, 20 years behind everything else. And this is likewise. I mean, a lot of production facilities, even in, Western societies, are still very much, manual with a bit of sort of like, programmable controller, never mind, obviously, Asia. And if you're trying to get more efficient and more production out of it, this has got to be a long-term winner, I guess, isn't it?
Yes. Yeah, that's what we think. We're thematic on this. I think it'll be in one or both of those portfolios for a while.
Yeah, and then just sort of finally, what key data points, sort of macro points, so you're sort of keeping a close tab on, and should investors keep a close tab on, because the thesis is such that we're going to get more inflation, the economy should still stay on sort of on track, etc. But if the thesis sort of changes, what things could trigger it and change that sort of thesis behind a lot of those macro calls?
Yeah, I mean, one of the weirdest things that I could tell you right now is there's so much uncertainty. We're even worried about the weather. If you have an extra cold winter, natural gas prices go up, create more issues.
Yeah.
Things on the virus could create more bottlenecks. But the key downside risks are slowing of corporate earnings, deterioration in the quality, meaning bottom line beats without top line beats. Stocks can still go up, but our multiple expansion is kind of unwarranted. That inflation continues to dangerously push higher. I don't care if it's Tepper, Tudor Jones, David Einhorn, the whole list of people that talked about it. It really is one of those things that I think you do have to worry about, and you have to worry about it more in the face of a loosening job market. Good news is right now the wages are increasing and the labor market continues to tighten. Intermediate term, what usually gets us is extension of unsound credit. You get too much leverage, and there's certainly an incentive to put on leverage. I tend to ultimately fall in Tom Lee's camp, who's a friend and another one of those folks on our advisory board, that markets go up most of the time. We're long-term investors. I think we want to always be in the game. It's just a question of degree and a question of where. And I think you have a good sense for some of the type of things we're doing. If we were to protect, I think, with volatility as low as it is, I think put spreads are interesting, and not as expensive as long as you don't hedge to zero. By doing the spread, I think it makes a lot of sense, and writing out of the money calls. And we're not doing a lot of that right now, but if investors are scared, I start with rebalancing, and then I start to incorporate these things specifically for taxable investors.
Brilliant. Okay. Well, thanks very much, Rob, for your time. Terrific insights. And if anybody wants to sort of invest with NewEdge Wealth, where's the best place and the best person to sort of contact?
So I would just reach out via our website, www.newedgewealth.com. And there's a place on there that you can reach out to us. We have many clients in the UK, typically through offshore based investment accounts, and we can be a great choice for that. So we'd love to talk to any of your loyal followers.
Fantastic. All right. Well, as I say, I would point investors to, if you want a who's who of not only on the advisory board, but also high quality stocks. I mean, as illustrated what we talked about, I mean, it's the best in class in most of their sectors. So it's just for investors, just to sort of know what type of things is a real sort of education. So thanks again for your time, Rob, and look forward to speaking going forward.
It's my pleasure, Paul. And if your customers want to keep up with our letter, they can subscribe to it. We do a weekly letter. I think it's one of the best in the business. We've been on this inflation call for the last 3 months. One of our analysts is really tremendously fantastic. I would call him our head of research, Bill Inglis, and he's really, really thoughtful. The entire investment team of Jay Peters, Kevin Miller, Ben Lope, Bill, Rick Holman. We've got quite a group, and I think we think differently. And if you want to keep up with our insights, it's not an easy read because there's a lot of detail in it. Yeah, but it's certainly pretty thorough.
Well, I'm going to sign up to it. That's for sure. And you're not a bad investor yourself, Rob. So thanks. Thanks very much.
Thank you so much, Paul. It was good. It was really good being here.
Thanks.